So yeah, hi friends. So welcome to our channel. So today we'll be going to have a look at the option trading's basics. Okay. So this is like to learn what is called option, what are the type of options available. So this is for an educational purpose. So please do your own analysis before taking any real trade based on this educational content. Okay. So yeah, friends. So option trading's basics. So there are two types of options available. So one is call option, which is named as a CE, and one is put option, which is named as an P. Okay. So if you have a look at that option strike price, and if that strike price is mentioned as an CE, then note that it is an call option, and if the strike is mentioned as an PE, then it's a put options. Okay. So we can either buy or sell the call or put options based on our directional views. Okay, so I'll be telling you guys when to buy or when to sell, whether when to sell call options or when to sell put options or buy or sell. Okay, and we actually, you guys can come through the word that writing and call option or writing and put options, right? So writing is nothing but it's selling and options. Okay, so in options trading we can earn money on following market conditions. Okay, so even if the market is bullish we can earn money, and if it is in bearish we can earn money, and even if it is if it is trading at a flat, right? So it's trading in inside and range, so even at that market conditions we can earn money using then options trading. So we cannot earn through either directly through an equity or an future market if the market trends in a range market. Okay, so buying and put option, so you can see that it's an limited loss and unlimited profit strategy. Okay, so whenever you buy an option, put options, it comes with an limited loss, but it comes with an unlimited profit as well. Okay, so if you are bearish of a stock, you can buy a put option by paying premium, and you can profit from decline of the stocks. Okay, so let's say you are bearish on particular stock, so you are not sure about to sell the futures. Okay, because like future selling comes with an unlimited loss, right? So if the stock moves start moving upside, then you will be coming with you'll get an unlimited loss. So if you buy an put options, you'll be buying that if the stock declines and starts moving downside, you'll be getting the profit, and even if the stocks doesn't move down and if the stock starts moving upside, you'll be going to lose only the whatever the premiums you have paid. Okay, so it's like shorting the stock. Okay, because you're going to get the profit whenever the stocks moves down, so it's equal to an shorting the stock. So stock should close below the strike price of your bought put option. Okay, so you are buying an put option assuming that the price is going to move down, so the stock price should close below the strike price of your bought put option. For example, let's assume that the stock ABC is trading at rupees 150, but you think it will move down to rupees 100 by end of this month. Okay, then you can buy 130 PE put option, which may be available at the rupees 5 as a premium. Okay, so here the stock needs to move below 125 so that you will start gaining a profit. Okay, so if the stock doesn't move below your break even point, your maximum loss will be rupees 5 per share. What is the break even points, I'll be going to explain you in a later slides. Okay, so for buying and put option, whatever the premium you have paid to buy that put options rupees 5, right? So that is the maximum loss you are going to make per share. Let's say if the stock lot size is 1000, then if you are paying that 5 as a premium, then you can max loss only the 5000 in that particular trade. Okay, so buying call option, so buying call option is same as like a put option. So most of the theoretical things will be same as like a call option, but here the only difference is if you are bullish on the stock, then you should buy the call option. So in a put option, if you are bearish, we need to buy the put option, and if you are bullish on the stock, then we need to buy the call options. Okay, we'll be going to get the profit whenever the stock starts moving above our strike price. Okay, so it is equal to buying the stocks. And here for example, if the stock is trading at 150 and by expiry you think it will reach 200, then you can buy 170 at 5 rupees premium, and if the stock starts moving above 175, you will be in a profit. So again here it's buying an option, so which comes with a limited loss, because you are going to make only the loss of the premium which you have paid. So here you'll be getting the loss of max rupees 5 if the stock tends not to move above your strike price. Okay, So here comes the selling the put option. Selling the put option, which means you will be going to get a limited profit only, but you will get an unlimited loss. Okay, so trader will initiate a short put if he thinks stock will not below the certain level and it will take a support. Okay, so if you think that the stock will not, if let's say there is a support level at some price level, so you think that the stock price will take the support at a particular price and it will not move beyond this level for this current month. Okay, then you should sell the put options. So seller will collect the premium upfront and hope option will expire worthless by the time of expiry. So whenever you sell the options, right, and if the stock price is not crossing that strike price, then the particular option will expire worthless, which means that it will end up with the value of 0 or 0.5. Okay, so for example, if the stock is trading at 100 and trader think there is a support at rupees 90, okay, then he think that the stock price will never move below this 90 level, so he will be selling that 90 PE at rupees 5 and collects the premium. So he will be getting the whole profit of rupees 5 rupees if the stock price doesn't move below 90. Even if the stock is trading at 91 or 90, he will be getting the whole 5 rupees as a profit. Okay, so max profit here is rupees 5, but if some case due to some uncertainty, if the stock breaches its support level and if it starts moving downside, for every 1 rupee move there will be an 1 rupee loss. It will start. Okay, so let's say if the stocks moves to 0 rupee, let's say, so then this put options will be at the loss of 90 rupees. Okay, so selling and call option, again it comes with the limited profit and unlimited loss. So trader will sell call option if he thinks stocks will remain below certain level. Okay, if there is a resistance at particular level of the stock, then he can sell the call options. Okay, so if the stock price doesn't move higher than that particular strike price, then the trader will get a profit. Okay, call option seller will get a premium upfront and once he sold the options. Okay, so all these things will be same for both the put options and the sell options, but in call options we should stock should trade below the sold call options. Okay, so stock, for example, if the stock trading at 200 and trader thinks the stock will not move about 230 for this current month, then he will sell the 230 call option at rupees 10 and he collects the whole premium. Okay, if the stocks close below 230, then the trader will get a profit. So here we'll be going to have a look at risk versus reward. So profit of put option will start from break even point on downside movement. For example, if the strike is 100, you bought the 100 strike price with the premium of 5. Okay, so then your break even will be rupees 95. So to get the profit from that put option at the time of expiry, the stock should trade below 95. So here is an example calculation to get the break evens. Okay, break even is like strike price plus premium you paid will be your break even points. So in put option you should minus, it's not a plus, so I done some mistake in my PPT. Okay, so break even is strike price minus premium, which will be your break even for the put options, and for the call options the break even points on the upside movement. So the strike 100 and premium is like, let's say for example 5, then the break even will be 105. Okay, so to get the profit in option buy, stock should cross break even, and in put option selling we will be getting profit if stock expire above strike price, and in call option selling we will get profit if the stock expire below the strike price. Okay, so this is for the basic examples, and so thanks for watching friends. So please do subscribe to our channel and please click on that bell icon so that you will be getting a notifications whenever we upload new videos, and please comment if you have any queries. So thanks for watching.